Hey everyone, if you've got money in a 401k, cash sitting in a high-yield savings bonds or bond funds, broad market ETFs like SPY or QQQ, some gold as a hedge, or even tech-heavy positions, pay attention for the next few minutes. Right now, the bond market is at a crossroads that could quietly affect the purchasing power of everything you own. Just in the last couple days, weak jobs numbers sent the 10-year Treasury yield dipping to around 4.16% before bouncing back near 4.21%, and the yield curve steepened to near its widest in 4 years. The stake here isn't some big crash, it's whether your money keeps up with the economy or slowly loses ground to inflation and rate changes. What most people missed is how the yield curve just widened sharply and what that really means for the road ahead. By the end of this video, you'll understand exactly what's happening in the bond market right now, why 4.25% became such a flashpoint, and how to think about your portfolio without chasing headlines. First, the problem, the recent moves around 4.25% and what shifted the calm. Second, the mechanism, layers of what's driving it, from the simple stuff to what pros actually track. Third, your action plan, practical ways to watch and position thoughtfully. Let's start simple. Bond yields move inverse to prices. If yields rise, bond prices fall, and vice versa. Think of it like a seesaw. Higher yields mean borrowing costs more, which ripples to stocks, mortgages, everything. In the last few days, yields dropped after soft labor data. The 10-year hit a low near 4.16% before settling around 4.21%. But the bigger story is the yield curve steepening. The gap between short-term 2-year yields and longer-term 10-year yields widened to about 72 basis points, one of the widest levels in 4 years. That's not the old inversion panic, it's steepening, which often signals markets are betting on growth or policy shifts ahead rather than immediate recession. Quick pause. Has your bond fund felt calmer or jumpier lately? Think about it for a second. People sometimes think yields dropping means everything's fine. But the short-term dip came from weak jobs data, while the steepening hints at longer-term questions around fiscal spending and how many Fed cuts we actually get. Layer 1. The bond market is like a giant opinion poll on the economy. When yields hover around that 4.25% level, a number watched closely since late last year, it acts like a magnet. Cross it, and positions adjust fast. The recent trigger was weak labor indicators. Private payrolls added just 22,000 jobs in January, way below expectations. Job openings dropped sharply, and layoff announcements were high. That pushed investors toward bonds, lowering yields temporarily. But at the same time, fiscal deficit concerns and talk around Fed policy kept some upward pressure. It's like a tug-of-war between slowdown fears and sticky inflation plus government spending. Here's a quick humor break. Everyone was saying higher for longer just a few months ago. Well, the bond market just whispered, maybe not quite so long. Pros zoom in on that yield curve steepening, 2-year to 10-year spread around 72 basis points now. That's a shift from inverted to normal or even steep, which can point to growth potential but also reflects uncertainty on the Fed's path. They track Fed cut pricing. Markets are now expecting around 58 basis points of cuts this year, up a bit after the soft data. They watch deficit and treasury supply. More bonds issued can push yields higher, and the dollar index, since higher yields tend to attract capital. Duration is how sensitive a bond is to rate changes, like how a long car needs more space to turn. Longer bonds swing harder when rates move. So far, we've covered yields volatile around 4.25%, curve steepening on mixed signals. Think back to 2018 to 2019. The curve flattened and inverted, then steepened as the Fed paused hikes. Markets adjusted without a crash. That's just an analogy, not a guarantee. Cycles aren't identical. Some say a steep curve always means boom times ahead. Reality, it can signal growth potential, but it also reflects uncertainty on how the Fed balances cuts with inflation and deficits. We watch the data closely. For your portfolio, a steeper curve can support stocks longer term because it hints at cheaper borrowing down the road, but expect more volatility if yields whip around. Tech and growth names are especially sensitive to rate changes. Cash in high-yield savings still looks solid near 4% plus. Bonds, shorter duration ones, tend to be safer if yields rise again. Gold can act as a hedge in uncertainty, though it hasn't always moved in lockstep lately. Another quick analogy, after the 2022 tightening cycle, yields rose, the curve inverted, then normalized as the Fed signaled a pause. Stocks wobbled but recovered on soft landing hopes. Again, just an analogy, not a prediction. If bonds are the adults in the room right now, they're saying, kids, let's not get too excited, things are recalibrating. And the big myth, bond market moving, means crash coming. Reality, it's more about transition, higher volatility likely, but not automatic doom. This isn't financial advice, here's a decision framework to think through. If your goal is long-term growth and your time horizon is 10+ years, you might lean toward equities and ETFs, but consider trimming if yields spike hard and stay above, say, 4.5% for a while. If your focus is preservation, maybe closer to retirement, favor shorter bonds, cash and diversification away from long-duration stuff. If you're thinking inflation hedge, a small gold allocation makes sense, but watch real yields too. Watch list to keep on your radar: the 10-year yield support around 4.10%, resistance near 4.40%, the 2 to 10 spread, if it pushes above 80 basis points, that's more of a growth tilt. Fed speakers and jobs data, the delayed January report, and next CPI are huge. Dollar index above 105 could pressure risk assets. Risk management checklist: keep position sizes reasonable, no more than 5 to 10% in any one bet. Diversify across stocks, bonds, cash, commodities. Avoid leverage, especially in volatile bond moves. Rebalance quarterly, not daily on headlines. Imagine your portfolio as a boat. The curve steepening means wind is picking up, so trim the sails if needed, stay balanced. Quick recap: bond market volatile around that 4.25% level, curve steepened on weak jobs versus fiscal and policy mix. It's a signal of transition, not crisis. We walk through simple yield dynamics, pro-level metrics like the curve and Fed bets, and what it means for your holdings. Use frameworks over forecasts. Here's the reframe: what if the real break isn't something shattering, but the bond market quietly forcing a smarter, more balanced portfolio reset? If this helped clarify things, drop a like, subscribe for more macro breakdowns like this, and turn on notifications. Next video dives into what to watch next week. See you soon. Stay steady out there.